where you're listening from. We've got people joining us from the United States, Australia, Hong Kong, and also down the road in Surrey. So regardless of where you've joined us from, thank you for your time today. My name's James Green. I'm the UK Regional Manager for Blevins Franks, and I'll be your host today. So I'd like to make some introductions. So I'm joined here by Matt McClure from Lumon. Matt, would you like to introduce yourself?
Yeah, thank you, James. Yeah, Matt McClure here from Lumon. I'm one of the senior traders here. We're a currency exchange brokerage based out of Farringdon, London. We've been in business for 25 years back in August now, just assisting with clients moving transfers internationally for property purchases or property sales, things of that like.
Lovely, thank you, Matt. And I'm also joined by one of our advisors at Blevins Franks. We've got Mark Leaney here joining us, a UK financial advisor. Mark, would you like to introduce yourself?
Good afternoon, everybody. Yeah, my name's Mark Leaney, financial advisor with Blevins Franks, 35 years worth of financial planning experience. So as you can probably imagine, I've seen quite a lot over the years and some extraordinary times. So yeah, thank you very much, James.
Lovely, thank you, gentlemen. So it's just a quick overcap of the agenda. So I'll be taking the first section, to giving us a bit of a recap of what's happened since our previous budget. I think it's quite important to understand where we are today with how financial advice is implemented as at today, bearing in mind what's coming next week, essentially. Matt will also be covering off how a currency broker can potentially help with your situation and covering off how he can help. And then Mark will be going into the body of the webinar, covering off some speculative areas, trying to help us see the forest through the trees for next week. So this webinar, it will be recorded and it will be circulated along with our contact details. So we would love to hear from you afterwards with any further questions you may have. We have tried to answer as many of the pre-submitted questions as we can, but you may notice there is a chat box on the side. So please do ask questions as we go through, and we will try and have time for Q&A at the end. I think it's important to understand that this webinar is not giving you financial advice. We're just giving information based on speculation as of next week, but then also where the financial market is as at today on the information we know. And I think it's always important when you're having a plan, ultimately, if you ask yourself a few questions on what you're going to be doing in the near future, would you be buying a car that wouldn't get you to a destination? Would you be selling a property that ultimately you weren't sure if the survey was going to come back clean? So ultimately, why would you be amending your investment portfolio or moving your pension if you didn't know what that outcome was certain? So I think if you're planning on doing anything between today and what's happening next week, I think you need to ask yourself two very, very key questions. Are you certain of the outcome? And does it still tie in with your long-term goals and plans? Ultimately, if the answer is no, or I'm not sure, I'd certainly be questioning why you're implementing that advice. After all, a sound financial plan is built on certainty and clarity, and any plan that's built on the unknown usually ends in unfavorable results, and ultimately those results cannot be undone and doesn't tie into those long-term plans either. So I think it's important to understand where we are at this point in the cycle. I mean, ultimately, it's not unique. This budget's not unique. There's been many, many budgets in the past. There's been a lot of speculation building up to it. So, I mean, I just took 30 seconds before this call just to have a quick look at the headlines in the build up to the budget last year. And just to remain unbiased, I've got 4 randomly picked headlines. And the first one, the Daily Express, fears Labour budget could wreck the economy. So that was dated in 28th of October, just building up to the budget as of last year. The Daily Mail, same time last year, Labour's budget ploy will punish mortgage holders. Jeremy Hunt warns interest rates will stay high for longer after Reeves rips up the rule book to borrow an extra 50 billion sterling. The Daily Telegraph, biased office for the public budget responsibility paving the way for Reeves's tax grab, warns Hunt. And then the last one, remaining impartial, we have the Times. Prepare to face reality in the budget, public are told. I think other than the budget being obviously the key headline, the other one there is obviously Mike Amesbury fighting in the streets of Cheshire, the Labour MP. So I don't think it was the media coverage they wanted in the build up to the budget, the first one in 14 years. But I think what's the key takeaway here is they're all simply fueling that speculation. A newspaper giving you bad news will always sell more than a newspaper giving you good news. After all, that's how they are remunerated. But a lot of that is ultimately useless, not unless you know what actually happened in the budget thereafter. So that's where I've got a few touch points going into what happened in the budget as of last year, just so you simply know where they are today. I won't go into all of it because we don't have enough time for the rest of this year to go through it all. But ultimately, the first speculated area is, I think it's almost laughable when you hear it out loud. So there's going to be personal tax cuts. So I'd love to see the maths involved with a bill that ultimately raises 35 to 50 billion sterling, but yet we're getting personal tax cuts. So it would be an interesting math to look at that. Bear in mind, if we just look at the basic tax rate of 20%, it's been that since 2007. So the government are probably seeing that as good news, the fact that that hasn't been hiked. But then when you look at the fact that, let's say in 2015, your average earnings was about £27,000 a year in the UK, depending on obviously looking at your resources, but that was against a personal allowance of 10,600. Let's fast forward to where we are today, and depending on your sources again, of course, your average earnings is somewhere between 37 and 39,000 pound a year. That's against a personal allowance of 12,570. So in the space of 10 years, your average earnings has gone up, let's say 12,000 a year, but yet your personal allowance has gone up less than 2. But the government are giving us good news that tax rates aren't going up. So what you're actually looking at there is a stealth tax, because yes, whilst the tax rates are remaining the same, the average earnings are actually going up and claiming more in taxes. The next touching point is a relatively short one, coming after landlords with this stamp duty land tax on any additional dwellings. So that did get speculated and it did get implemented, increasing from 3 to 5%. And they've been coming after landlords for a few budgets now. And it's probably not the end of it. There is potentially more to come, because it's not the only way that landlords could be affected. And I'm sure Mark might be touching on that quite shortly. The other small one I'd say was the British ISA. So they were looking to increase the allowance by about £5,000 a year, as long as that 5,000 was going into UK stocks and shares. I think person to person, I think it's relatively little, which is why it was put on the rumour mill for quite a short period and it didn't come into fruition. But I think in the wider scheme of things, if there's a few million people investing further funds into UK stocks and shares, it may have been good for the economy and also good for employment as well. The next point for me is probably one of the chunkier ones, I think, because we're looking around sort of some of the IHT planning and business property relief and the AIM market as well. So both previously outside the scope for inheritance tax, assuming you had it for 2 years, but then business property relief now has an allowance of £1 million. Anything less than that on death is free of tax. Anything in excess of that is then taxed at 20%. Moving on to AIM, they don't have an allowance, but they do have a flat rate of 20%. So it's quite interesting. I was speaking to one of our providers that help in that area, and the provider will remain unnamed, but ultimately they're an underwater sea creature with 8 tentacles, so take what you wish from that. And interestingly, they were saying they actually see that as a good thing, despite obviously their assets now being taxed. And the reason being, they feel they've got the seat at the mainstream table now with the rest of the market. They've previously kind of just been left to sort of get on with whatever they need to on their own. But now, because they have a seat at the table and they have their own designated allowances, they feel like the industry is now sees it as longevity and sees a real player in the market. So it was interesting to see that they saw it as quite a positive step forward overall. And the last 2 bits from me, they probably tie in a bit together. The first one being pensions falling into the IHT trap. So from April 2027, any unspent pensions will fall into your estate and be taxable for IHT, assuming you are in excess of your available nil rate bands. I mean, the reason it's been kicked down to 2027 is because ultimately, mechanically, how is that tax going to be declared and deducted? So to paint a picture, most people pass their assets down to their children, and that's usually when the first IHT bill is actually then paid. So if I have a daughter who's a high rate taxpayer, let's say, she has to take a withdrawal from that pension, assuming that my parents have died post the age of 75. So she's instantly paying 40% on that withdrawal. And then she's using that money to then pay another 40% in inheritance tax. So there's a bit of a double bubble there. So realistically, it's been speculated, not confirmed yet, but the sensible approach would be for the pension provider to pay HMRC directly. So ultimately that beneficiary won't see those funds, but they can still pay an inheritance tax bill. And I think the planning around pensions is interesting, depending on what you view on what interesting looks like, to be honest, because we've had generations of people now that have been told pay into a pension, pay into a pension, because you'll get tax relief on the way in, and ultimately it'll help fund you in retirement. But realistically, what we're seeing now is money going into your pension. There's speculation for a number of years now about how much tax-free cash you're going to be taking from it. Any income drawn from it is taxable as well. And now they're all saying whatever's left is also taxable under IHT. So it just begs the question whether we should be saving into a pension going into retirement, or whether we're looking at additional opportunities elsewhere. And there are many opportunities. I mean, it's horses for courses. There's many on this call now. Many of you will have a different view and a different vehicle to help you into your retirement needs. The last point I'd like to touch on is the abolishment of the non-domicile regime. So previously, we obviously used to assess inheritance tax in the UK based on your UK domicile. And there's many of you on the call that are living abroad and have been abroad for a number of years. And under that regime, you could have been abroad for anything up to 20 years, let's say, as an example. And had you not taken the correct steps, you could have still be fallen into the UK domicile and therefore assessable for inheritance tax. What it's moved to now, it is a residency-based system, which is something similar. They see to quite a lot of our European counterparts, and they just simply look at your residence of yourself, but also looking at the residence of the assets as well. For the leavers, for example, they'd look at if you've been a tax resident in 10 of the last 20 years, in which case you'd have an IHT tail, what we refer to, on the way out. But then once that tail drops off, then so does the IHT essentially, and you can live your life abroad knowing that any assets outside the UK are not liable to inheritance tax. The other key people it's actually there for, which is some people that's applicable on this call, are for the returners. So the quick rule is if you've been outside the UK for 10 years or more, then you're classed as a non-long-term resident. And assuming you've structured your assets correctly, you can benefit from a 10-year window where ultimately you benefit from IHT relief. Within that 10-year window, the first 4 years, you can actually also benefit from the FIG regime, so foreign income and gains. Ultimately, again, assuming you have the correctly structured assets, you could have tax-free income, tax-free growth for 4 years. So there's some quite large benefits there. And hopefully you can see through some of those points that I've just gone through based on the previous budget, is there's some good news, there's some bad news, there's some very much indifferent news. But I think what's key about everything is there's planning opportunity once the outcome is known. So for me, that's the key point for me. You always know the outcome with a key financial plan. So much like my two daughters, you don't have to listen to me too much longer anyway, because I will now be passing over to Matt, who will now go on to his section. So I think, Matt, what I'll do is I'll kick off a question for your section, if that's okay, which is a pre-submitted one. So I think the question everyone's asking ultimately is, why should I use a broker over a bank?
Yeah, well, thank you, James. It's quite a good question, because I guess maybe people don't really know too much about how the currency side of things work. But I mean, I've been here for 5 years now on the dealing team. So I was here at the end of the COVID periods. I saw Trump leave and come back. I've seen the Liz Truss situation, there's a new change of government, and the Labour situation as well. So, you know, we have a real experience in volatile markets. I mean, when it comes to comparing us to other services like a bank, I suppose one of the main reasons we've existed in the first place is because typically banks don't offer very competitive rates of exchange. You know, we exchange close to £10 billion worth of currency every year through this dealing desk, which is around 30–40 million pounds a day on average. So that allows us to buy at a much more competitive rate. So we mystery shop banks to help understand the average rates and fees associated with exchanging currency. And on £50,000, you can expect a saving of maybe £500 to £1,000. So it does make a difference, of course, and that's what we're here for, is to offer more competitive rates. And that, you know, that becomes more apparent the more you scale that up, really. But yeah, when you're looking at then the movements in currency as well, it becomes even more apparent, because let's take sterling dollar, for example. It's a great example of how currencies can move so drastically. It's had an enormous amount of movement this year. I mean, it's gone from 121, that's how many dollars you'll get for a pound at the start of the year, and it's gone all the way up to 137. So that's a difference of over 10%. If you're looking at moving £500,000 to dollars, that's about $80,000 difference on on just over the year alone. So yeah, it does make a huge difference. And we're not here to offer you advice or tell you what's going to happen, because quite frankly, no one knows what will happen. But yeah, just to offer you that experience, guidance, and as well as just market information around what might happen. So you're making more of an informed decision ultimately.
Sounds like I should be planning a holiday to America sometime soon, then to spend a few more dollars. So to give you another question, obviously we've got people on the call that are moving from one country to the next, and they may not have any assets there, or they may not have a bank account to send funds that way. Does that stop them speaking to you now?
No, of course not. I mean, essentially what you have here is what we call a free multi-currency account. So you can send any major currency here and hold it here for as long as you need, and we'll initiate the payments when you're ready to do so. We're what's called an e-money institution, so that means that we're able to hold funds here for as long as you need, and your funds are all fully protected under the safeguarding method. And that's essentially where we hold your funds in a segregated account under your name, instead of pooled with the rest of your funds, which is how we differentiate from different services. And like I said, that's only available because of the volumes that we transfer and the length of time we've been around. But yeah, like I say, if you are concerned about the rates, we just want to have some understanding of what your currency means in real terms right now. You could always have that discussion around the timing first of your exchange, and then holding the funds here as well. But yeah, there's no fees for setting up an account or just having a conversation with us, and so I would definitely implore anyone to do that.
Interesting, thank you, Matt. Obviously, you just touched on Trump, and it's hard to listen to Trump's name and not hear some form of market movement being associated with it. So how have recent events impacted the market, and also what can you do to help out with that?
Yeah, as you said, there's a lot of different topics this year, depending on what you're doing. Sterling dollar, sterling euro, sterling Australian dollar. The tariffs has been a huge topic of conversation this year, and the implications on global trade, interest rate cuts. It's been a pretty busy year. But of course, one of the biggest talking points, what we're talking about on this webinar, is the budget next week, and all the speculation around it plays into currency markets a lot. So there is a saying in the currency world where the market moves on expectation just as much as fact, and that is definitely true in this situation, because we still don't really know what may happen at this budget, and that's what you need to plan around and make sure you are aware of any pitfalls when it comes to currency as well. We do that in many ways. For example, we receive forecast data from over 50 financial institutions and research teams. And we share that with our clients, but just to kind of give them an idea of what might happen, in the 1, 3, 6, 12 months ahead, just generally. And then as well as that, you've got several contract types to match up with that. So if you were thinking about getting ahead of it, or you saw that data and wanted to go ahead with an exchange, you can use a forward contract, for example, where you purchase the currency now, and we essentially freeze the rate for you for a future date. We can set a limit order, which is essentially where we have a target rate of something you'd like to achieve, and we'll monitor that on your behalf to get to that point. So yeah, like I say, they're the type of things that will help you just have, I guess, more peace of mind around how much your currency is worth, and remove any risk of the rate worsening by the time that, I don't know, you complete on a property or something you need to have an understanding of the cost of.
That's interesting. Thank you very much, Matt. It's interesting to know that we're all staring into the same crystal ball, essentially. That we're all trying to plan, but ultimately we only know what we know today. Unfortunately, that crystal ball doesn't tell us anything about next week, but we can help ourselves by trying to cover all of our bases. So thank you very much, Matt. So to hand over to Mark, obviously Mark will now cover some of the speculated areas based on next week. So Mark, the floor is yours.
Thank you very much, James. Yeah, so I think we're all pretty much aware that the Chancellor has already set the scene for tax rises, which will be announced next week, and everybody from homeowners right through to pension savers could well be within her sights. So it's also acknowledged that there is an estimated £30 billion fiscal shortfall, and that's putting pressure on the government and ultimately on the nation's finances. And with the apparent abandonment of the 2p rise in income tax, which would have been pretty unpopular in the light of manifesto pledges, we have to think about where else the money might come from. So let's chat through some of the rumours, because there's loads around. So we're just going to concentrate on what we consider as being the probably the major ones. So I'll begin with pensions. There might well be, as James alluded to earlier, a reduction in the amount of tax-free cash that can be taken. It currently stands at £268,275, but this could be reduced to as low as £40,000, and this has prompted quite a number of clients to actually take the plunge and withdraw their 25% allowance before any budget announcement. There could be a cut in pension tax relief for 40 and 45% taxpayers, with rumours circulating that this could be cut to as low as 30%, which will obviously have quite a big impact. And a major one that's kind of surfaced in the last few weeks is around salary sacrifice. And that could mean that contributions are capped for both employer and employee contributions. And there could also be some tax exemptions removed completely. So that's a big area of speculation, and one which could well come to fruition. James, did we have a couple of questions around pensions whilst we're on that subject?
Yes, Mark. Yeah, I've got two previously submitted questions around the pension side of things. It's interesting around the salary sacrifice. I think it's quite a recent regime, but the fact that they're already speculating around that's certainly interesting. The first question I've got is actually quite a common question between a few people that have joined the call. And ultimately, is it better to leave the pension in the UK or transfer abroad? There's a few European countries named.
Yeah, I think that's a really good question, and one that we're being asked quite a lot at the moment. So I think all I can say is that we would treat each case on its merits on an individual basis and offer tailored advice once we've established a full and complete picture of client circumstances. There are a number of considerations, particularly around things like the overseas transfer charge. There are things like the policyholder and scheme need to be in the same EU state for 5 years for tax efficiency reasons. Cure ops can't be forwarded to another jurisdiction for 5 years without paying the overseas transfer charge. And there is some good news. There is a SIP provider in the UK that can offer euro denominated funds and payments. So there's quite a lot to consider, and it's really crucial to get the right advice before you would proceed to move a pension.
So it sounds like it's not quite a yes or no answer, and there's not one size fits all.
Definitely not. No.
And then I suppose in follow-up to that, again around the pension planning, I know I've had quite a few clients contact me on this subject, and I'm sure you have as well, Mark. In advance of the budget, I've taken my 25% tax-free cash. Where should I invest it?
Yeah, it's another great question. Again, we're able to offer advice on where best to invest once we've got a full understanding of the client's aims and objectives and their hopes and fears. So to put it simply, what we will do is we will find out where you are now, where you want to get to, and what we can do to help you get there. So again, there's no off-the-peg solution. Every client is different and advice is tailored in that way. But what I can say is that it's really important to seek proper advice, even if you're a seasoned investor or indeed an experienced investor as well.
So it sounds like a financial roadmap is quite key to the planning. I suppose if I'm planning something today, it doesn't mean it's going to happen today or tomorrow. There's probably a few steps involved.
Yeah, absolutely. Yeah. So if we move then on to kind of the next area, which is around inheritance tax, which is, again, there's lots of rumours flying around with regard to this, so there's a fair bit to think about. There could well be an increase in the gifting rule from 7 up to 10 years, which would have a significant impact. There may be the introduction of a lifetime cap on gifts made. There could be adjustments to the existing rules around taper relief. And another suggestion is a freeze on nil rate bans beyond the current date of 2030. So that could be extended further into the 2030s. And also another major consideration is the introduction of capital gains tax upon death, which at the moment is exempt, but could well be introduced because it would produce some pretty significant tax revenue. So that's kind of the inheritance tax piece. There could be, on other taxation areas, there could be wider reforms of capital gains tax. There could be a potential freeze on income tax thresholds, again, extending the timeline for those from 2028 right through to 2030. And that will capture more tax as wages rise. And indeed may capture pensioners as the state pension is expected to outstrip the personal allowance by 2027. So again, that could be a significant announcement. James touched earlier on landlords, and is there further bad news around the corner? There could be the possible introduction of national insurance on rental income. The figure that has been quoted has been 2%, but it could be higher, it could be lower, we just don't know. But again, it would be quite a good revenue raiser. And that could impact on landlords' decisions going forward, along with potentially an introduction of capital gains tax reform, which will also hit landlords if they decided to dispose of properties within their portfolio. I mentioned savers earlier on. They could be hit by changes to the cash ISA rules. There is the possibility of a reduction in the contribution levels from 20,000 down to 4,000. Again, this is to encourage investment ISAs, particularly within British companies. There are also rumours around council tax reform, how that's going to look, mansion taxes for higher value properties, and different figures have been mentioned there. Some say 500,000, some say 1 million. And stamp duty reform is again very much on the cards, but that is a little bit sketchy at the moment. Will motorists be hit? Possibly. There could be a mileage tax introduced. The latest figure that I saw was 3p a mile for motorists. That could be a significant hit, which it has been mooted. There have also been whispers around wealth taxes for higher net worth individuals and exit taxes as well for those leaving the UK. These appear to be relatively unpopular amongst certain government circles. However, they cannot be completely ignored, because if they are introduced, they could be pretty significant. So I think that these are the main areas where speculation is definitely rife, but clearly the devil will be in the detail on the 26th. So it's either going to be a really extraordinary day or pretty much a damp squib. But either way, I think the overall message is, once the announcements are made and everything is become a little bit clearer, it's going to be absolutely crucial to get proper, tailored, comprehensive financial advice, so that you don't make the wrong decisions at the wrong time.
Lovely, thank you, Mark. Obviously, you mentioned exit tax, and there are a few people that have joined the call that are looking to leave the country in 2025 or even early 2026. So what are your expectations for an exit tax?
So we don't really know how this is being viewed overall within government. There are some in favour, some against. The proposed exit tax, which is also likely to be referred to as a setting up charge, would impose a 20% levy on unrealised gains. So that's gains which are yet to be realised from UK business assets when an individual ceases to be a UK resident. So that would include shares in private companies and other financial instruments. So it could be quite a tricky one for individuals who are leaving the UK. So those taxes would apply even if they are not sold at the time of departure. So that's a big move away from where we are currently, where individuals who become non-resident can often avoid UK capital gains tax on assets acquired or held whilst they were resident in the UK. provided they dispose of the assets after leaving and they remain abroad for at least 5 years. So this new proposal is really down to seeking alignment to close that gap and seek alignment with some of the other G7 countries, such as France and Germany and Canada, who already impose exit taxes. So I guess the message is we don't know. The devil will be in the detail. But if it is introduced, it could be a significant, it could have a significant impact on clients and produce big levels of income for HMRC.
And thank you, Mark. And I suppose one of the quite a broad question that we've got here is what impact will the budget have on moving overseas?
It's difficult to say. I think the most important thing is to see the detail when it comes out. What we do with Blevins Franks is we don't just look at the impact of budgets in the UK, we also look at the impact of budgets in the jurisdictions in which we operate, and that's really important. So, for example, in Spain, we've got, there are 17 different tax jurisdictions, 17 different regimes, and it's very difficult to negotiate those kind of choppy waters. So whenever there is the possibility of a move, it is really, really important to seek advice at an early stage so that you don't make the wrong decision at the wrong time. And that's where Blevins Franks, with its cross-border capability, is there to help and support clients who are potentially going overseas to the jurisdictions in which we work.
Sounds like it's complicated areas in Spain.
Yeah.
So I've got a question here for you, Mark, as well. And to be honest, it's not actually budget related, but I chose it out because I think it is quite a key one around planning. And I think it's everyone on the call certainly needs to know this, but it's a short question. Do I need to make a will?
Yeah, absolutely. I think will writing is a fundamental building block for any financial planning scenario, for the very reason that the last thing you need to do is to introduce complicated things like the rules of intestacy, which are in some cases quite nasty. So you want to make sure that the will is in place so that your wishes are carried out in full. I think we also encourage the use of lasting powers of attorney, because again, they can be very useful in clearing up any sort of complications should they occur later on. So a combination of wills, lasting powers of attorney, fundamental building blocks in any financial planning scenario.
Lovely. Thank you, Mark. It does sound critical. So that moved us on from the main body of the webinar. So this is the section where we would move to the chat to see if there's any live questions. But from my side, I can't see any questions coming through. Matt, can you see anything from your side?
Not just yet, no. Yeah, I can't see anything at the moment. So feel free to pop any in now if you do have any questions on what we've discussed. Yeah, I'd be happy to answer any of them, really.
Yeah, hopefully we did cover a lot of the questions that were pre-submitted, but we do realise that obviously listening to this call may stem a few more questions, at which point, if you can't think of them during this call, by all means, you will get our contact details after this webinar then goes out, and feel free to contact Matt, Mark, or myself, and we'll be more than happy to help and follow up. But I'll give it a couple of more seconds just to see if a question comes through. And if not, what we'll do is we'll draw a line in it there, say ultimately, whether you're planning on leaving the UK this year, next year, or whether you're planning on returning to the UK, or whether you're looking to enter one of our core jurisdictions in Europe, we'd love to hear from you and start conversations early. It's key to make a financial map and a plan. It doesn't happen today, it doesn't happen tomorrow. It does take time, and clarity and understanding is needed. So start conversations early, do reach out. Over the next week or so, we will be releasing more on social media through Facebook, through Instagram, and through LinkedIn. So please follow those for key details around the budget planning. And then also please sign up to our newsletter, because as a result of that, you will get a key breakdown of what has happened in the budget and how that can affect you in the near future. But that's it from myself, Matt and Mark. Thank you both for your time today. And thank you for all our listeners today.
Thank you.
All the best. Have a good day.
Thank you. Bye.
Thank you.